Hello and welcome. This is KYC on NDTV Profit. I am Agam Vakil. Well, in a world where we are bombarded with so much more information, well, we thought that it would always be a good idea to perhaps get you a deeper and cleaner and perhaps a simpler version of the companies that we want to present to you, give you a better idea in terms of what these companies do, how they have performed, what this could potentially look like down the line, and further perhaps even get clarifications from the management. And this certainly could be perhaps a little bit more actionable in times when we have so much data to work with. Well, on KYC, that is Know Your Company, we have Gro Capital. And well, to tell you a little bit more about Gro Capital, it's a NBFC, that's a non-banking financial company, and what it does do, that it's technology based at the moment, so there is a little bit more focus when it comes to tech. But in terms of the various areas that it lends to, well, about a third of its lending comes from small businesses, and another third comes from secured loans. That's followed by 10% of its loan mix coming in from MSME and loans as well. Moving on to the other segments, well, we also have plenty coming in from supply chain, machinery loans, as well as partnership. But this is as far as what the company does. Well, every single quarter, every episode, pardon me, what we actually give you through and take you through is a handful of parameters which could give you a better idea on how the company's performed in the past. And among the many factors that we do consider, in fact, well, we are taking into consideration, well, the income statement, the balance sheet check, the operational metrics, as well as asset quality. And among other parameters that we do consider is shareholding, street coverage, street credentials, as well as valuations. But to take us through all of this as well, I also have with me Harsh Saita, my colleague, who could perhaps shed a little bit more light in terms of how the company has done so far. So Harsh, thanks for joining in. Let's start with just the income and the kind of growth that we've seen for the company going forward.
Well, growth has been extremely strong, Agam, as you can well see. First off, on a lower base, but the net interest income, which is the NII growth, on a year-on-year basis, FY24 numbers is what we look at for now, has grown at 40% YOY in FY24. It continues to grow at a very similar kind of clip even in FY25, but the 3-year CAGR is what really impresses me. Top line has literally grown 37% YOY over the last 3-year period, which is extremely strong. But the key metric here is whether that is actually translating to profitability, right, Agam?
Right.
And that could be impacted by provisions, and that's what we look at before we look at the PAT number. The provisions number at around 116 crore in FY24 on an asset base of 9,000 crore is fairly reasonable. But you've come out of a good cycle, so that's something we'll need to keep in mind. And the 3-year CAGR with regard to provisions is 81%, but again, the base is low over there, and the YOY growth is around 105%. So it's doubled YOY, but again, off a very low base.
Right.
Therefore, let's look at the profit after tax at 119 crore for a 2,000 crore odd market cap company, and I'm talking FY24 numbers. The YOY growth has been 200%, so very sharp rise in profitability. And the 3-year CAGR as well is 61%, so very healthy compounding in terms of profit with regard to the way in which income is shaping up. And the provisions have not really, gone out of hand, if I can call it. That's how it's essentially playing out on the income statement. Definitely a thumbs up for me here.
Okay, so that's as far as the income statement is concerned, and of course this is to a certain extent a function of its AUM growth as well. So let's take a look at how its assets under management have also grown over the past many years. And what you can see is on a year-on-year basis, we've seen its AUM grow by nearly 50%, and over 3-year CAGR, it's a staggering 90%. So in terms of all these metrics, well, it's panning out that we saw in the income statement. It's to a certain extent with respect to the kind of AUM that's been. But I just want to point out that as on FY24, its AUM was 9,000 crores. And as of now, it does seem like the number has moved above the mark of 10,000 crores. So it's certainly going to be a thumbs up here as well. But what's next on our radar is operational metrics, Harsh.
Right. Let's go to operational, because this is where all of the numbers will start stacking up as to how profitability is coming about. Look at the yields, okay? They've moved from 14% to a higher number of 17%, given that we saw rate hikes. And thereafter, it's settled in at around 16.5%. So currently, FY24, FY25, roughly that's the kind of number that we're settling in at. Cost of funds is concerned, extremely stable despite all the rate hikes. So that's something that we'll have to look out for, and we'll probably ask the management as well as to why this is so. Why our cost of funds and what's really giving that stability to cost of funds. Last off, with regard to your ROA number, it's gone from 0.6% to 1.1% to 2.3%. Now the key here is they've guided Agam to a 4% ROA.
Yeah.
How quickly do we get there? And of course, you can see the kind of journey, the speed at which the ROA is doubling. It's almost doubling every year.
Right.
How quickly can we go from 2.3 to 3 and from 3 to 4 is
right.
what I would be really, really curious to understand. But just given the trajectory of the ROA, it's on an increasing trend. That's a positive. But at the moment, a 2.3% ROA for a business which lends to small, medium enterprises
right.
with high risk,
right.
well, that's something that one would have to really keep a lid or a watch on as to how that number really evolves. And that's why I'm giving this a bit of a neutral, given the way in which these numbers are panning out.
Fair enough.
We'll have to wait and watch. If that ROA number goes to 4, the re-rating could be fairly quick on this one.
Right. Okay, so talking about risks, and it's interesting that you pointed out that because it's, you know, the company lends to relatively smaller businesses, the risk is certainly high. And based on that, its gross NPA and net NPA ratios seem to be very much in check. In fact, over the course of the 2 years, they have actually come off. So if you consider the FY24 gross NPA ratio, that's come down to 2% as against 2.3%. Sure, fair enough. On a year-on-year basis, we've seen an increase there as well. And when it comes to the net NPA ratio, again, it's a similar picture. An increase on a year-on-year basis as compared to FY23, but certainly a vast improvement as compared to FY22. So given the fact that in the long run, we have seen an improvement, a decline in your gross NPA and net NPA ratios, well, I would give this a thumbs up as well. Now let's talk about, well, the shareholding as well, Harsh.
Yeah, well, so for shareholding, the promoters currently own just 2.2%. A large part of that, or pretty much all of that dilution has happened because it's a lending company.
Yeah.
It needs to continuously raise equity capital. And that's likely the reason why the promoter ownership is this low. And you will only expect this to get lower. Again, for context, we'll probably ask management a question on that as well, try and get perspective. But look at where the institutional investors are sitting. They're sitting on a healthy 25% or so in terms of holding, and that's remained largely stable on a sequential basis. Your public holds, so there's a very large free float, which is currently sitting with institutional investors and public, obviously, given that promoter ownership is so low. So that's probably just the one piece which could be a concern, that whether promoters have enough skin in the game, because that's generally the metric we look at when we're looking at shareholding, but also understand it's a lending business. So you're going to have equity dilution at all points of time.
Right. Fair enough, and point taken there as well. So with that, let's also take a look at what the street is making of this particular stock. So firstly, we must remember that this is not a very large company. It has a market cap of a little over 2,000 crores. And yet you still have about 7 analysts on the street covering this company. It's not very often that something like this happens for a company this size. But all analysts on the street currently have a buy rating, as in they are positive on the company, and more importantly, with the kind of price target that they put in terms of consensus, that comes in at a little around 362. That implies a over 50% return from current market levels. So that certainly is a big positive, given the kind of credentials that the company has. And based on that, we are certainly giving it a thumbs up. And you know what? I believe that it's not done too badly either since its listing, Harsh.
Yeah, it's not. It's actually doubled up since listing.
Yeah.
And therefore, it's given, or rather, since 2021, since it's listed on the National Stock Exchange. And in its new avatar, since 2018 as well, it's done fairly well for itself. But let's take August 2021 as the metric, because that's when it actually listed on the NSE. Last 12 months, it's given a negative 12% return. And we saw some of the profit numbers that the company has clocked over at least FY24, and therefore the kind of growth that it has seen versus the kind of return it has given, not really commensurate, right? So a large part of that doubling has happened, especially in the first 2 years between August 21 and August 2023.
Right.
Now, let's talk about the last 1 month. It's down 25% from the high fair, but in the last 1 month, it's given a 6% return. So is the stock coming back in vogue? Well, that's questionable. But overall, when you're looking at the 3-year chart, and generally at KYC, we look at the longer term, it's done fairly well for itself.
Absolutely. Well, any stock which has doubled over the course of the 3 years certainly is giving you a reasonable amount of returns. But let's talk about valuations as well, because that's something that we usually touch upon. And in terms of that, compared to some of its peers on the street right now, as you can see, and in this case, we're taking price to book ratios and not necessarily price to earnings. Gro Capital currently at around 1.1 times, as against something like Capri Global at 4 times, Credit Access Grameen at 2 times, is the same for Mass Financial. So it's certainly going at a discount as compared to some of the other peers, especially given the kind of growth that the company has seen. So it does seem like it's going at a discount, which is why for this particular aspect as well, we're going to give it a thumbs up for the company. But that comes down to the kind of rating that we have. So let's take all these parameters together and see what kind of rating this totaled up to. So as far as the KYC rating for this particular company is concerned, that comes to, in terms of the income statement, the balance sheet check, operational metrics, and asset quality, it's about 3.5 out of 4. And among the next set of parameters, again, good for street coverage, street care, and valuation, so another 3.5 out of 4. That brings the total to around 7 out of 8. So certainly, a good rating as far as KYC is concerned. So that's the overall rating that we have with respect to what the company has done in terms of fundamentals, as well as the kind of expectations from the street going forward, keeping valuations in mind. But from there on, we very quickly talk about your SWOT analysis. And I'm going to talk about strengths and weaknesses as far as Gro Capital is concerned. So firstly, when it comes to strengths, well, it's an extremely fast growth company, and that certainly plays in favor of the company. And it's maintained its asset quality, more importantly, especially given the kind of segment that it caters to. The weakness perhaps would be return ratios, which at least the street is saying that they need to be just need to strengthen a little. And the MSME segment is a tough segment to deal with. Sure, the company has done well so far, but it is something that could see a lot of volatility. It's not necessarily company specific, it's industry specific. But Harsh, let's talk about opportunities and threats as well.
Well, huge opportunity, Agam. The company currently has an AUM of roughly 10,000 crore.
Right.
The size of the market currently is 25 lakh crore plus. In fact, the unaddressed market, some reports suggest, are at 25 lakh crore. So the kind of opportunity size available and the sector in which they deal with, the opportunity size is extremely large. And again, would be great to take perspective from the management here on how they plan to tap in and how much of that they plan to tap in incrementally.
Right.
Second one, with regard to operational efficiency, a lot of that is still yet to fully kick in. We saw how ROA ratios have gone from 0.6% to 1.1% to 2.3%. So you've got an increasing, you have a doubling trend with regard to ROAs. Can that sustain?
Right.
Well, that's a strength, because as operational efficiency kicks in, ROAs will continue to improve likely. Right. But there are threats as well. If growth slows down in the sector as a whole, you're likely going to start to see a low base, a smaller company with an AUM of 10,000 crore grow at a lower clip. Is that so or not? Well, again, we'll try and venture a question. And second piece is with regard to the cyclicality and asset quality. Right. These, the MSME cycle, if that were to kick in, how much does that affect someone like a Gro, smaller player, tech-enabled, uses AI for lending? Can they really substantiate the kind of growth that they are getting with asset quality? Well, that's a question, but it's a threat as well. So
okay. Fair enough, fair enough. So there you have it. That's an overall comprehensive view on what the company has done. But you know what? There's no better time to actually talk to the management of the company than now that we've discussed all these parameters. So in fact, we have with us right now on the studio Mr. Shachindra Nath. He's the founder and managing director at Gro Capital, who joins us to take on questions that we have for him in terms of prospects going forward. But with that, I'm also going to hand it over to Harsh. Take it away.
Well, thanks for that, Agam. First off, good morning, Mr. Nath. Great having you here, in person. Thanks for taking out time and coming here.
My pleasure.
So first off, I want to understand, with regard to the addressable market itself. I was just speaking, and probably you had a chance to listen. 25 lakh crore is the kind of market size. Are you going to target certain pockets? And how are you going to maintain asset quality comfort while you are lending and growing at such a fast pace?
Yeah, this can be answered in many ways. I think so. Challenge is when you talk to an anchor who's a chartered accountant and a karate black belt, then you only talk about numbers, right? But actually, you have to look much beyond actually.
He's done his research and come.
Yeah. So actually, it's much beyond that. If you look at India as a country today, I keep saying that India actually is dependent on small businesses. I keep saying that if you look at the political structure, there are multiple types of polarization in India has happened. Finally, we are reaching to economic polarization, which means you need to provide jobs to the people, irrespective of what kind of spectrum of political dimension you are. Right. Whether you are left, right, or center, it doesn't matter. The job have to be created because people have to be fed. And in India, the only, after agriculture or probably equal to agriculture, the only sector which is providing jobs is MSME. And the credit is related to that. India, if it has to reach actually the 2047 target of to be a developed nation, MSME has to contribute almost 50 to 60% of GDP. We today employ roughly around 17, 18 crores in MSME. It has to go down to almost 25 odd crore. We run a campaign called MSME Achha Hai because the problem or the challenge, I was listening to your commentary, problem or challenge is we continue to believe that MSME is a weak segment. This is a 5 or 10 years past trend. One of the ways to think about a bank and a non-bank, there was a point of time when consumer financing was not there. I keep giving this example that my father, when he has to buy a scooter, he has to wait for 6 years and he has to save money to buy that scooter, right? There was a point in time when gold was, lying in people's locker and it was not a, monetizable asset for credit purposes. So as tractor finance and others. Whenever a player who focuses on certain segment on some broad metrics, you will see size and scale, especially for something where governments are focusing. If you look at last budget speech, the amount of focus government has put on MSME as a segment and series of things which has happened from 2014, combined with a massive data infrastructure, there are three big changes in India has happened. A behavioral change. Post demonetization, small businesses which were largely in kacha economy have realized that paisa unse nikala ja sakta hai and that they started converting to more or less pakka economy. Second, the credit assessment methodology, which was predominantly very physical, you have to assess non-reported income. Post the establishment of GST, digitization of banking and bureau is becoming more and more formal. And third, the segment of the market which is growing the strongest, which is the Bharat segment, we call it 15 lakh se 15 crore turnover ka customer segment, is actually MSME Achha Hai. And you said 25 lakh crore of unmet demand, actually it is somewhere between 70 to 80 lakh crore. And almost 90% of that is for 15 lakh to 15 crore segment. Ugro focuses on that segment. It's hard to build. What we have achieved in 3 years, what people have achieved in 15 years. There is no comparable. Public market actually doesn't reward us for that. But there is no comparable in India that our journey started technically in 2019 and we suffered from COVID in 2020 and then we restarted in 2022. In 2020 and we were only in 850 odd crore and we are now touching more than 10,000 odd crore. So in 3 years time, somebody to build in a scale of 10,000 odd crore, have large global investors, 60 plus lenders, almost every DFI in the world, and holding the portfolio quality. Some bit of is our work, but more of it is the ecosystem around MSME financing is changing, and not Ugro. You will see in next 4, 5, 7 years, very large financial institution around MSME would emerge, and we are hoping we will be one of them.
Sure. Mr. Nath, my question is to do with asset quality, and you guys have been able to maintain a very good asset quality, especially given the kind of segment that you guys cater in. But there is some expectation, some anticipation that things could potentially turn at least slightly for the worse. Your anticipation in this case and how you potentially look to tackle this?
Yeah. No, look, I think so there are, analyst fraternity actually look at NBFC or the credit market in one uniform way.
Yeah.
Actually, that is not true. What is happening to consumption market, what is happening to, say, microfinance industry, what would happen to affordable housing finance industry may not necessarily translate to small business financing. Small business financing is directly linked to overall economic growth, right? And within that also you have to look at what we call 50 crore and above turnover businesses and small retail businesses. As long India's consumption economy is growing, people are buying goods, they are going to stores, they are consuming in local market, we think so that the small business economy will remain resilient.
Right.
Now, only thing what you have to be very careful is how do you assess. So the critical key, we say in lending there are three things: the intent of the customer, his eligibility, and his ability to repay. Now, ability to repay is what is the most critical.
Sure.
And within cycles, you have to readjust that.
Right.
We follow, while we invested very heavily on data analytics plus technology, but we follow one simple principle of what we call yield to loss ratio curve.
Right.
More expensive you are a lender, more potential of losses and more variability in your credit cost.
Right.
So you have to build your portfolio from a very low yield. So our ROAs looks more depressed than vis-a-vis some of our other peers said, because we follow a very long-term approach, saying that 70% of our portfolio have to be secured, almost 50% of that has to be at 12.5% yield. We are increasing our branch network for high-yield business very, very rapidly, so very heavy OPEX is going on that.
Right.
But ultimately, we say that we have to be in a median yield band of, say, 16, 17 odd %. We have to gradually increase our yield so that we can control the credit costs and we don't become greedy to do every business in high yield segment.
Right.
Because in short tenor, you can be very, very profitable, but you don't want to be like a microfinance company that which every 2 years then you have to take losses. Because ultimately, we are fiduciary to both shareholders and lender, and you have to be true to that.
Yeah.
Fair point. So you've guided for a 4% ROA. Two questions here. One, how quickly do you get there? Two, what kind of credit cost do you build in to get to a 4%?
Yeah. So look, why 4%, right? So we continue to believe that as a company, like banks, I heard you saying that the promoter holding is not so much of positive. Financial services, India is actually a little odd. There is all the banks in India, technically they have no promoters. But market is overweighted for NBFC, some of them which are actually bigger than the banks, but all of you like some big promoter to be there, right? It should not be the case actually. So actually in lending market, because it's a systematic risk to the final ecosystem, if you follow the principle, the ownership should be restricted in a bank, so should be the case of the NBFC itself, right? Sure. And actually for a professional, turning entrepreneur to build size and scale, you cannot have ownership unless you decide to take out the money from your own company and start putting in the equity itself. Right?
Fully hear you, fully appreciate.
Yeah, so that is one point of that. Second, we have to get to a certain best lending companies or financial services company have to be consistent. And why investors or institutions or market would like it, once you get to a certain level of return on equity and return on asset, certain percentage of growth, and you show consistency. Some of the best banks in India, till the time they are best one, they showed consistency. And what it means, you grow at 25 odd %, you cannot grow at 50, 70 odd %. We grew because of our lower base. You deliver at least 3 to 4% return on asset. Now, return on equity is purely a function of leverage. Right. So, large corporate-owned NBFC get the benefit of leverage, and that's why their return on equity is very significant.
Sure.
For somebody like us, leverage is kind of impossible, but we have found a way to offset that by creating an off-balance sheet business. Yeah. So, our weight and approach to get to 4% is to continuously increase our branch footprint. So we were 25 branches in 2021, we went to 75. Last year we were comfortable at the what we call the micro enterprises business, which is small ticket size, 9 to 15 lakh rupees secured ticket loan. And then we started investing very, very heavily. We are at around 250 odd location. We should be at 400 location. Today, our micro enterprise business, as of September, what roughly around 11 odd %. We are hoping that that would become 35 odd % by 2026. That portfolio is at an yield of around 19 odd %. It would come down to 18 odd %. But the sheer contribution of that business going up would increase the ROA. But actually, investors, other than the long-term patient investor, public market investors, what I've learned in last 3-4 years, don't have patience for 8 quarters, 10 quarters, or 15 quarters. Everything is judged basis 1 quarter. For a company which is opening 50 odd location in every quarter, a company which is adding 1,000+ people to increase this branch. So your operational efficiency is a function of time when you mature. We are hopeful that we show consistent performance on these metrics. At some point of time, investors would start liking it. Because this is the same market where investors also sometimes like companies which have no profitability, which have only gross revenue but no bottom line, and people lap it up very, very quickly. Versus a company which is doing some fundamental businesses.
Fair enough, sir. Point taken. And Mr. Nath, we will leave it at that. Thank you so much for joining us and giving us so much more insight into the company and what we can expect going forward. Unfortunately, this conversation has been enough. There were plenty more questions that we had for you, but that is all the time that we have.
Some other time for sure.
Absolutely. We look forward to having you again on NDTV Profit. But on that note, it's a wrap on this edition of KYC. Lots more lined up on the other side. Stay tuned to NDTV Profit.